interest is one of those 4 AGI deductions. Now, there are a couple of different qualifiers that we have to talk about with regard to student loan interest. Obviously, if it's student loan interest, it has to be associated with some kind of loan that was taken out for education, right? Specifically, it's a loan taken out for higher education. Okay, so if you take out a loan to send your kids to private school, K through 12 private school, that does not count for the student loan interest deduction. So that's one of the qualifiers. It is only for higher education. And it would cover interest paid on loans for any of those educational expenses. We're going to talk about what those educational expenses might be. This just kind of goes through, I'm sure you're all familiar with having to borrow, or will be familiar with having to borrow for education. Maybe some of you aren't. DMAC's got lots of great programs that can help students avoid doing that. But when individuals borrow money in order to finance their education, after they leave school, whether they graduate or not, and by the way, make sure you graduate, because having a bunch of student loans and then not having a degree is not very conducive to financial security. But when you take out those loans, then obviously, like any loan, there's interest on that loan, and you have to pay it back. So the interest portion of that loan could be deductible depending on certain factors, as long as you took it out for qualified expenses. So oftentimes, parents will take out loans to finance their kids' education, another thing that is not really very advisable. But it does happen. So the person that is obligated to make the interest payments is the one that can take the deduction. Okay, so if it's the parent that took out the loan, the parent gets to claim that deduction. Okay. Married filing separately, this is one of those restrictions for married filing separately. They cannot claim this deduction at all. They're not eligible to claim this deduction. Okay. All right, so we'll look at an example here. Gabriella borrowed $5,000 for higher education expenses on a qualified education loan. And your problems aren't going to ask you to define whether it's qualified or not. Okay. She began making payments on the loan. She was still living at home, and her parents appropriately claimed her as a dependent. In this case, I skipped over that part, sorry. So if the individual who is responsible for making the payments on the loan is a dependent of somebody else, they don't get to take the deduction. Okay? She was still living at home, and her parents appropriately claimed her as a dependent. In this case, she cannot claim the student loan, student interest deduction. Although she was legally obligated to repay it, she was claimed on the return of somebody else. So if you're dependent on another person's return, even though you're making the payments, essentially that just means nobody gets to take the deduction, right? Now, there is a dollar limit. This is the first limit, other than it has to be for qualified education expenses. There is a dollar limit to the amount of deduction that you can take. It is capped at $2,500 a year. So if your interest on your loan is more than $2,500 a year, first off, you can't take more than the $2,500. So if you paid $3,000 in interest, I'm not talking about the principal on the loan, just the interest. $3,000 on interest, you're capped at $2,500. That's the first cap. There are other limitations as well, other dollar limitations based on, what do you think it's based on? If it's a dollar limitation, this is a type of deduction. Income, what kind of income? AGI, that's right. So there are other limitations based on AGI, okay? As they mentioned here, the deduction may be further limited based on the AGI of the income, or AGI of the taxpayer. Let's see, there were some, again, so student loan interest payments right now, well, I guess not anymore. They September 1st, they restarted the payments. They were suspended because of COVID, then it was extended, and then it was extended, and then it was extended, but now it's not on extension anymore. So for the last few years, there are probably a lot of people that weren't paying any interest on their student loans, so they didn't, maybe they otherwise would have gotten this deduction, but they didn't pay the interest. So they wouldn't have had that. All right, so first off, it has to be a qualified educational loan. So it's incurred by the taxpayer solely to pay qualified education expenses on behalf of the taxpayer, spouse, or any dependent of the taxpayer at the time that the loan was incurred. Okay, so you might be a dependent, you know, you're 18 years old, and you're a dependent on your parents' return, you take out, they took out a student loan on you, you were a dependent at the time, right? So, at the time that the loan was incurred. It has to be solely paid for educational expenses, so you cannot take out like a $10,000 home equity loan and I'm gonna pay $8,000 toward my education and $2,000 toward fixing my driveway. That loan was not taken out solely for educational purposes. That would not be a qualified educational loan, okay? The educational expenses have to be paid or incurred within a reasonable period before or after the loan date. This is to prevent people from using those loan proceeds for something else. Taking out a student loan and then not really going to school or not really using those proceeds for something else. Then it would not be a qualified student loan payment. Any federal education loan will meet that criteria. So if it's through the federal government, it would meet that criteria. You have the expenses must occur during the period that the recipient was carrying at least half of the normal full-time workload for the intended course of study. It can be at any level, associates, bachelors, graduates, whatever, but it does have, you do have to be in school at least half-time for that loan to be a qualified loan. So that's a qualified loan. Qualified expenses. The cost of attending an eligible educational institution, so there's another qualifier there, it has to be an eligible educational institution, including tuition, fees, books, supplies, equipment, room and board, that is included here, transportation and other necessary expenses of attendance. So if your books that you purchase, if you had to purchase a laptop in order to do your schoolwork, that sort of thing, those would be included as qualified educational expenses. Now, if any of these items were received, so those tax-free scholarships that we talked about last chapter, if amounts were withdrawn from any of those educational savings accounts to pay for school, if you had any tax-exempt savings bond interest and it was tax-exempt because you used it to pay for school, the employer gave you any educational assistance, those amounts cannot be included in the calculation for student loan interest purposes, because essentially you'd be double dipping, right? IRS doesn't like double dipping, and I don't know of any, off the top of my head, I don't know of any instances where you can double dip, meaning you can take for the same deduction, you get it deducted in two places at the same time. But that's what all these rules are intended to discourage. So any other educational assistance excludable from gross income. However, that doesn't include anything that grandma gave you, your parents paid on your behalf, that sort of thing, or if you inherited money. So let's look at an example here. LeBron spent $3,000 on qualified educational expenses. I should love the names that they use. On qualified educational expenses. He received a loan for $2,800. I doubt that this is LeBron James. He probably wouldn't need a loan. Received a loan for $2,800 in the same month as he paid the expenses. Okay, so he's met the time requirements there. So got the loan, paid the expenses within the required time period. During the semester, he received a scholarship of $500, which was not taxable to him. So he didn't have to report that $500. In this case, his qualified educational expenses would be the $3,000 minus the $5,000. So $2,500 would be considered to be qualified educational expenses, so that whole amount. As a result, interest on $2,500 of the $2,800 loan will be eligible for student loan interest treatment. So not all of the interest from that student loan would actually be qualified. Why is that? Because his student loan amount, he actually got more than he needed to pay those expenses. You should have just got a $2,500 loan. The extra $300 would be non-deductible. So it's the interest on the remaining $300. Now, think about this for a second. A lot of people pay student loans on, they're paying student, my husband's still paying his student loans. He graduated in 1996. Yeah, it's terrible. So way back then, and you have to try and figure out, technically speaking, you're supposed to devise, okay, how much of this was actually spent on educational expenses, and think about it from 30 years ago, right? So yes, that is the rule. 9 times out of 10, all of the amounts that were taken as a loan, all of that interest would be considered qualified student loan interest. But there are instances where maybe some of it aren't. Okay, so you have to be, so we have these qualifiers here. So it has to be a qualified educational loan. It can't be more than $2,500. You can't take more than $2,500. It has to be a qualified educational loan that was taken out to pay qualified educational expenses. And you have to attend an eligible educational institution. So it can't just be any old educational institution. Now, if you go to a school and they offer you federal student loan opportunities, that is a qualified educational institution. Most educational institutions, even like trade schools as well, would be considered qualified educational institutions. However, there are some that would not be. So these are also institutions with an internship or residency program that leading to a degree or certificate awarded by an institute of higher education, hospital, healthcare facility that offers postgraduate training. Okay. Again, student has to be enrolled at least half-time during the time that they took out that loan. So we also have a limitation with regard to modified adjusted gross income. Again, modified adjusted gross income, we're always going to start with adjusted gross income, and then we're going to modify it with probably adding back certain amounts. All right, so in this case, our modified AGI starts with our AGI plus we're going to add back any student loan interest that we may have taken. So kind of like with that Social Security, we shouldn't include that in the first place, right? So we're not going to include any possible deduction that we would get for student loan interest. Foreign earned income that had been excluded, and any deduction taken for tuition and fees. Again, that deduction doesn't exist anymore, so it's not really relevant. So for our purposes, really, what we want is AGI before we've subtracted anything for student loan interest, right? Okay, so we would have to add that back. All right, so how do we do this calculation? So we've got a phase out range again. Remember we did that phase out with, what was it, remind me? Oh, it was the interest income for savings bonds that was used for educational purposes. We had that phase out, and I told you you're gonna see a lot of phase outs. This has a phase out range as well. So the deduction is going to be limited based on that modified AGI. Again, we're going to start with AGI, add back student loan interest, most likely that's the only thing, if we've deducted it. If we haven't deducted it, then it's just whatever that AGI is. So it is reduced when modified AGI reaches 145,000 on a joint return or 70,000 on a single return. So, so for married, I'm going to put single up here first. Our top range, or it starts to be phased out, 70,000. At the 70,000 mark. So once our income reaches that point, right? For married, and remember, married filing separately doesn't matter because they don't get this deduction at all, right? They don't get, so, and this would just be married, everybody else would be counted as the single amount. So for married filing jointly, it starts at 145. Our phase out, this is where our phase out range starts. It ends at 85,000 for single and 175 for married. That means that if your modified AGI is below these amounts based on your filing status, you get to take all of the student loan interest subject to the $2,500 limit, right? So if you had $3,000 of student loan interest, you're single, your modified AGI is $65,000, you had $3,000 of student loan interest, you can take $2,500, right? Because you're still limited to that $2,500. If it's over these amounts, you get nothing. You get no deduction for that. Between these amounts, this is our phase out range, okay? So as you can imagine, we've got another calculation to do, right? Very similar to the calculation we did before with the savings bond interest. All right, so this is the formula that's used. We take our preliminary deduction. That preliminary deduction can never be over $2,500, okay? So that's our first test is, okay, how much is our student loan interest? Is it over or under $2,500? If it's over, then it's $2,500 for our preliminary deduction. If it's under, then we can use that number. So 25 or less, 2,500 or less is our preliminary deduction. Times the fraction that applies here. This is the amount of interest that is disallowed. So be careful here. This is not the interest that's allowed, it's disallowed. So let's do this. Let's say we've got somebody who is single with modified AGI of 76,000, and they have student loan interest, and we'll assume that it meets all the qualifications. It's qualified student loan interest. Student loan interest of 4,300. And we apply our calculation here. So remember, our preliminary deduction is not 4,300, it's 2,500. That's the most that we would be able to take. So, $2,500 times their single, it is our modified AGI minus 70,000, minus the lowest number there, divided by 15,000. Where does that 15,000 come in? That's our phase out range here, right? We're essentially looking at the fraction of income that is within that particular range here. So 2,500 times 76,000 minus 70,000 over 15,000. All right, so somebody else is going to have to do the math for me here because I don't have my calculator up here. My calculator's right there recording. So 6,000 divided by 15,000. Sorry? 0.4. 0.4. So this is 0.4, right?
Yeah, that's
That proportion. Okay, so 0.4 times 2,500. disallowed. So the last part is we have to take our preliminary amount minus the disallowed amount. They can take $1,500 deduction. Like I said, you're gonna see this, and this is like this denominator is always gonna be whatever that range is. So you can imagine, so this is 30,000. If it's married, that denominator is gonna be 30. Yeah.
What's the 4,300 again?
4,300 was the total amount of student loan interest that they paid.
Oh, okay.
Mm-hmm. But they don't get all of that. They're limited to 2,500.
Okay.
Now, if they had, let's say they had 2,300 of student loan interest. Well, now this amount is going to be 2,300. Okay. So it's 2,500 or the amount of student loan interest paid, whichever is less. So 2,300 times the same, we've got the same income here, 76,000. So now this is 0.4 times 2,300, which equals, whatever that equals. What's 4 times 23, 900 and, what is it? Why am I struggling with this? 920?
Yeah.
Okay. So 920, so in this case, they would get a little bit more, or actually, no, this is still gonna be our preliminary amount, 2,300 minus 920. Okay. So again, this preliminary amount is 2,500 or the actual student loan interest, whichever is less. Okay, yeah.
And then what happens if they're above the phase out range?
0. They get no
Nothing at
deduction.
all?
Yep. Nope. If modified adjusted gross income is over this amount for either of these, and again, it's married filing separately wouldn't count because they don't get the deduction anyway. This would be also for head of household. So if you're married, essentially, this is your range. Everything else, this is your range, except for married filing separately because they get nothing. Now this is yeah, go ahead.
Married and they both have student loan interest, do they both get 2,500?
That's a great question. No. It's 2,500, you're reading my mind, it's 2,500 per return, not per taxpayer. Which is one of the reasons why married filing separate doesn't get it. Because if you were married filing separate and you got it, then you could potentially double up, get twice as much as others. Now, I suppose they could make it $1,250 instead of 2,500, but yeah,
So if it's per return, if they're married filing separately,
they don't get anything.
they don't get anything?
No, married filing separately, filing status, you cannot take the student loan interest deduction.
Okay.
Not allowed. Okay? So here's an example. Shannon and Marion borrowed $30,000 on a qualified student loan to pay for qualified higher education expenses for their 2 children. During 2022, they paid $1,800 of interest on the loan. Their modified AGI was $165,000. So they're still under the 175. They're entitled to deduct $600, calculated as such. So preliminary deduction amount of $1,800. We take the modified AGI minus the lowest number here, divided by 30,000, which is the range, the phase-out range amount. This is the amount that's disallowed. You would subtract this from the preliminary amount to get what is allowed. Just be careful with that disallowed amount. It's very easy to forget that last step, that that's actually the amount that isn't allowed. But you can think about it, think about it logically here. Okay, so this is $30,000. If we're at $160,000, we're right in the middle of this range, right? Because that's $15,000 in. So they're gonna get half of whatever their eligible amount is. So you can kind of think as well, okay, if So 165, they're more than halfway into that range. So you know that whatever is allowed is gonna be less than half of this, right? Because they're over that by more than half. So just be careful with that allowed versus disallowed. Let's see. Just another example. So these are just kind of, so the 4 critical areas, whether the loan was taken out solely for educational expenses, whether the loan funds were used for education, the amount of the payment for the year, and the limitation based on those AGI phase outs. As they say here, loans made through the federal student loan program usually meet the first 2 critical issues because they're not going to give a loan to somebody who doesn't meet those requirements anyway. Let's see. There is a form that is received, and if you've ever paid student loan interest, you've probably received this form that reports the amount of interest that you paid. Be careful, this is interest paid, not received, right? Interest received would be on a 1099 INT. Interest paid is on a form called the 1098. And there are lots of different 1098 forms. This one is a 1098E form. So that's what it's reported on. I don't know if they give us an example. Yeah, so this is what it looks like. And I'm sure some of you have received this. And they list here the amount of student loan interest received by the lender. I have had clients who, they've got multiple student loans through all sorts of different lenders. And so they'll get several of these. That $2,500 is the total for all of them, right? So you gotta add up all of the student loan interest. And if it, in total, it exceeds $2,500, then that's your preliminary deduction amount. I had clients that were paying like I don't know how they did this, like $36,000 a year in student loan interest. Social workers. So you can imagine, that's awfully difficult. That's just the interest, right? That's awfully difficult to make payments on that, especially in that particular line of work. You guys are lucky, you're in accounting. If you take out student loan interest, you'll have plenty of opportunity to pay that back, because you'll be gainfully employed. All right, so this is just a student loan interest worksheet that you can take a look at. Use it or not, it's up to you. So again, so American Rescue Plan provides it for tax years 2021 through 2025. Any discharge of student loan debt for any reason, including private student loans, is excluded from taxable income. Remember I said in the last chapter, debt forgiveness is taxable income. They carved out an exception for a few years for student loan forgiveness. However, let me tell you, student loans are almost never forgiven. Even in bankruptcy, even if you file bankruptcy, you still have to pay your student loans back. It's very, very difficult for people to get out from under student loans. As long as there's no provision for the student to provide services to the discharging lender. Questions? Okay. We'll go on to the next one here.